Hello, this is Chuck Carnevale, co-founder of FastGraphs, and I want to personally take this opportunity to thank you for subscribing to FastGraphs, the Fundamentals Analyzer software tool. This video that I'm going to present here is what I like to call a what it is and how it works. And my purpose is to kind of give you a quick introduction into the FastGraph research tool to help get you started in taking advantage of all the powerful features this tool offers investors. I believe that FastGraphs are easy to learn and easy to use once you kind of get the hang of what we're actually depicting. So I'm going to go through a few examples here of various FastGraphs and illustrate some of the features and the power that FastGraphs provides. And one of the easiest ways to do that is to take the FastGraphs apart. So I'm going to start out by looking at fast-growing Ross stores here, and I'm going to take the graph apart here at the bottom so that I can rebuild it and illustrate several of the important features. The first thing is that FastGraphs plots earnings and/or cash flows per share with what we call the orange valuation reference line. We use three different formulas. There's actually two primary and then a third formula that's an extrapolation between the two that will apply a valuation reference to the orange line. When growth is high, like it is with Ross stores here, we'll use the formula P equals growth rate. So in this graph, this orange line is a PE ratio of 17.3. What's important is this is a reference. It's a valuation reference, because when I add monthly closing stock prices, which is the black line on the FastGraphs, I want you to notice in this quintessential example that the price tracks that orange line in the long run, and it's only over short periods of time where it gets separated from the valuation reference line, and that would indicate overvaluation when it's above the line, undervaluation when it's below the line. And what this perspective does is help you make sound investment decisions relative to valuation. It's not perfect, but it certainly gives you a good valuation reference. Additionally, if a company pays dividends, we also plot the dividends per share with this white-looking line. And this is a very important line for several reasons. In this long-term graph here, it's plotting the historical dividends per share, which are listed at the bottom of the graph here in numerical form. And the green shaded area represents total earnings. The area below this white line would be the portion of these total profits that the company pays out in dividends. And then we also stack those dividends, which are not here part of the company's earnings, and then we stack them on top after they've paid them out to you, the shareholder. Now this is important because if you calculate performance, if you go from the stock price from point A to point B, that will give you your capital appreciation. But then in addition to that, you get your dividend income. And that's what we do with our performance reports. We list the starting date up here and the ending date, the beginning price and the ending price, and then the number of shares that you would buy theoretically or metaphorically based on investing 10,000, but you can also adjust that amount of money here in this box. But once you're looking at that, so in this case, had you invested $10,000 in Ross stores on June 30th, 1997, and held it through yesterday's closing stock prices as I'm producing this video, that $10,000 would have grown to $288,399. Additionally, you would have received this stream of dividend income, and you can also then see how fast the dividend has grown and whether they've increased it each year. And so you get the cumulative dividends paid on a $10,000 investment plus the $288,000 of capital gain, which gives you a total of $303,000. Then we, just for perspective, compare that to the S&P 500. Now, another important feature of FastGraphs is they're dynamic. As you change these time frames by just clicking these orange rectangles, we automatically recalculate the performance based on the time frame that you're actually looking at. An additional line on the graph that we add is the normal PE ratio. Now, in the case of Ross stores, the normal PE ratio and the orange valuation reference line tend to be very similar. They're almost identical. Here you got a normal P of 18.2. So if I touch the blue line, it's a PE of 18.2. And if I touch the orange line, it's a PE of 18.8, which is equal to the growth rate. However, if I put a stock like Apple up here, a tech stock, Apple would be an example of a company company where the market has valued it at a much lower valuation. So here you see a high earnings growth rate of 28%. That would be the PE of the orange line over this time frame. But then you see that the market has had a penchant to value this stock at a discount. But this is strictly a reference. I want to make that clear because obviously during this period the PE of Apple was much lower than the normal PE of 17.4. And as you change these time frames, these numbers are dynamic and they adjust. So that also helps you determine things like whether earnings are accelerating or decelerating, etc. If you look at lower growth stocks, like I'm going to put a stock like the utility stock Scana up here, we're using what we call the Graham-Dodd formula because this is a low growth stock. And if you look at it from a long term, it's growing at less than 5%. So we're using the Graham-Dodd formula, but you still see this correlation. I want you to notice how price tracks earnings. And here, once again, you have a normal PE and a calculated valuation reference that are almost the same. So either one would be relevant. You also see here that this has a much higher payout ratio than some of the other stocks that I've shown you already. And for example, if I put a stock on here like Danaher with a very low dividend payout ratio, you can instantly and graphically see that they pay out a very small portion of their earning. This is also a good example to look at to give you some insight into where the normal PE ratio, at least relative to this company, the blue line, is a more relevant valuation reference than the orange line. The stock almost never trades at the orange valuation reference line, except for what we saw during the recession. But you also have all these other valuation metrics to review. For example, if I review Danaher using operating cash flow instead of adjusted operating earnings, I see a much clearer correlation. So for whatever the reasons are, the market has clearly valued the stock more in line with, if you will, its operating cash flow generation. And you get to see valuation from a point of view of operating cash flow. And then you also get to look at EBITDA, earnings before interest, taxes, depreciation, and amortization as well, and you get another valuation reference. All of these things are designed to help you make sound decisions on whether a stock is reasonably valued or not. And you have all these different iterations and all these different tools at your disposal. So when you're looking to make an investment decision, you can evaluate whatever stock you're looking at based on valuation. And let me give you a couple of examples here. You can see how Ross Stores price tracked earnings, for example, how when it got overvalued, it came back to earnings. It recently got overvalued and came back to earnings. But in contrast to that, you can look at a stock like Church & Dwight, which is Arm & Hammer baking soda, and you can see that this stock had a very good correlation between price and earnings, and then it became separated. Once again, you can look at this from different metrics like EBITDA, if you're a premium subscriber, for example, and get a different perspective. You still see massive overvaluations, and you see how this company's correlation to EBITDA has really changed in recent years. And you can also see that they've increased their payout ratio. So the tools are actually very simple. They provide what we call essential fundamentals at a glance and allow you to make very quick investment decisions. But there's also other aspects. For example, if you looked at a company like Ford, which is a reasonably popular stock out there, if you look at its long-term record, here I'm using EBITDA. Let's go ahead and put adjusted operating earnings back on the graph. You can instantly see by just running the graph on FastGraph that this has really not been a growth stock or a growth business or a growth industry. You can also see that they cut their dividend dramatically. So when you're looking at stocks perhaps for the first time, you can draw some of these graphs with a FastGraph and look at a stock like Click and Sofa here and see that this company's earnings are all over the place, and therefore it may not be the kind of stock that you would be interested in investing in. In contrast, you could look at a growth stock, a stock that doesn't pay dividends like LKQ Corporation, and you'll instantly see that there's a very high correlation with price and earnings. Again, you can run these other metrics. You could take the graph apart, add or delete these lines, and you can use this information to try to think your way through the process and help you make better investment decisions. Now, another point, and I'm only going to be focusing on the historical graphs here, you've got these external links where you can just simply go directly into any of these other spots, and I'll go into Seeking Alpha here. This will immediately take you to the data that Seeking Alpha provides on the company, but also directly through FastGraphs, you can go directly into the company's website. So part of our commitment to you, the subscriber, is to help you research stocks deeper and faster, more easily and more efficiently. Fast Facts contain a lot of essential data, blended PE ratio, dividend yield, if any, gives you the company's growth rates. These orange color-coded boxes give you the valuations of the orange or blue valuation reference lines. You have market cap, credit rating, debt to capital, and if the company has had any stock splits, there's also a little tab down here which will put stock splits on here. So the point is that this is really very easy to use once you get the hang of it. And so this what it is and how it works video is just try to illustrate that. Here you have a scrolling function where you can go back and look at historical time frames to be able to get more detail or just examine what a company looked like historically. It's a pretty simple tool. It does provide a lot of very valuable information at an instant. Certainly gives you a clear picture of valuation. You can see when a stock is overvalued or undervalued, and it just helps you make better long-term investment decisions. And again, you can look at US and Canadian stocks. There's over 20,000 of them. So that's kind of the what it is and how it works on the historical fast graphs. Couple little tips. You have this Fast Facts box up here at the top. If you click and turn the gray bar to white, then pop-ups will apply to give you some helpful hints on what these various things mean. That'll help you. Again, you can add or delete metrics by clicking down here at this orange rectangular bar, and that will add or delete items from the deal. You can add a custom PE ratio in this box. You can change the amount of money invested. If you have a specific amount of money invested, you can put it in there. And again, you have all these various metrics that you can utilize to help you make better investment decisions. This has been Chuck Carnevale, and this is what it is and how it works on the historical fast graphs. I hope it helps. And thanks again for choosing fast graphs.